Welcome to Chapter 3. And in Chapter 3, what we're going to do is start the completion of the accounting cycle. We're first going to look at adjusting entries. And actually, I'd just like to dig down into the adjusting entries right now. So I have supplemental videos and I've signed other assignments to hopefully give you an idea of what we're talking about when we complete adjusting entries. I would encourage you to look at the supplemental videos, the PowerPoint, the chapter, and get a good idea of what we're doing. But let me just give you my take on it. It's a little simpler take. It's not as precise, but it's simple. We need to make sure that the expenses that match revenues in the current period are recorded as expenses. Same thing for revenue. A revenue that's been earned needs to be recorded in the current period if it's been earned in this period. Everything else can be deferred. Okay, deferred means pushed off to a future period. So in the book, you probably notice it said accrue. I say bringing it into this period, or deferring. Really what we're doing. So either going to accrue, make sure it's recorded in this period, or just defer it to a future period. Show you what I'm talking about. Usually we can talk all day long about words, definitions, but when we actually go to do it, it just looks different. I like this problem, exercise 3-3. Prepare adjusting entries for December 31st. Every situation, ABC all the way to F, are different. Here are your accounts: cash accounts, receivable, supplies, prepaid rent, equipment, accumulated depreciation, equipment, wages payable, unearned revenue, services revenue. Now, unearned revenue, hopefully by now it makes sense. This is a liability account, right? Services revenue, wages expense, supplies expense, insurance expense, rent expense, depreciation expense, equipment. So, A, depreciation of the company's equipment for the year is computed to be $18,000. An adjusting entry. We're going to do the depreciation entries at the end of the accounting period, and we're going to do it as an adjusting entry. We're going to debit depreciation expense. The problem gave us the numbers. There's no math to do. Depreciation expense, we're going to debit expense. All expenses are debited, right? We know that's a normal balance. Debit is a normal balance for expenses. Debit depreciation expense, credit accumulated depreciation equipment, $18,000. Accumulated depreciation, new term, contra asset. Now, when we talked about dividends in the prior period, we call it a contra equity account. Depreciation is a contra asset. In other words, it's going to be the opposite of an asset. Assets, the normal balance is a debit. So what's the opposite? A credit. So accumulated depreciation, the normal balance is a credit. That's why it's credited here. We're increasing the accumulated depreciation for equipment. Moving on. B, prepaid insurance account has a debit balance because it's an asset. The normal balance for assets is a debit on December 31st before adjusting for the cost of any expired coverage. That means used up, consumed. Analysis of the company's insurance policies showed that 1,100 of unexpired insurance remains. So let me show you what I see when I read a problem like this. And I think a T account does best, okay? So let's get some extra white area. You know what? For me to do what I just tried to do, I'm going to have to get out of ink mode. Perfect. And into ink mode. Okay, so this is what I see in the prepaid. I'm going to abbreviate a lot. So that's prepaid insurance. PPD is prepaid and INS is insurance. Well, it says it has a $6,000 debit balance on December 31st. So that's the ending balance before any adjusting entries. And what they did is they found that they've used up most of the prepaid insurance. And what that means is it's used up a little bit every month. The prepaid insurance balance should go down. So if you prepaid insurance for a whole year, let's say a whole year, January to December, right? Every month in between, I know there's more months than the hash marks I have, but from January to December, if you prepay in January for the whole year, by December the balance should be zero. What happens is every month it goes down. Prepaid insurance goes down a little bit. Instead of making payments, monthly payments, like some of us do to insurance, we're drawing it out of prepaid insurance, is showing that a little bit every month, making the prepaid insurance go down. I'll just say that, okay? So if that's the case, how much should prepaid insurance have gone down? In other words, we need a credit, the opposite of a debit, to make it go down, as a credit, right? So what did we need to make it go down? A credit for $4,900. So when I see this problem, this is what I see. I have a credit to $4,900. So instead of paying cash every month for insurance expense, we paid it all at once and put it in prepaid insurance. We still have a monthly expense, which means that the journal entry is we now expense for $4,900, and we have prepaid insurance of $4,900. That is just a weird looking column there. And on the handout, I got a copy of the handout. It's not that way. It's something weird in Word. All right, just disregard it if we can. And that's it. And if we were paying cash every month, I'm still in eat mode. If we were paying cash every month, it would be a debit insurance expense, credit cash. But we're not paying it every month. We did the prepaid insurance. So what they did was they prepaid it, and at the end of the month or the end of the quarter, whatever this is, end of the year, they looked at it and said, oh, you know what? We should only have a balance of $1,100 in the prepaid insurance, and what's been consumed is $4,900. All right, that's it. See, the supplies account had a $700 debit balance. Let's just keep going. I like the T accounts. I think it explains a lot. Let's just do it again. All right. Supplies account had a $700 balance at the beginning of the year. Assets have debit balances. So $700 at the beginning of the year. So that was the beginning of the year. BOY. And during the year, $34.80 in supplies were purchased. So that's a debit. Now on December 31st, somebody went into the storeroom, office supply storeroom, let's say, and they said, well, we only got about $300 left. So the only way to get from this large amount all the way down to this small amount is a credit. So 700 plus 3,480 minus 300. That's how I work it. All right. And I haven't done it, so let's do it on a calculator real fast. 700 plus 3,480 minus 300. So I have it on the other page. I should have said, and I didn't want to change the screen. 3880. We have to have a credit for 3880. So in other words, we have to have supplies expense. This is supplies expense. So the other T account is supplies expense. And we know expense is always a debit, right? All right, let's look at the journal entry. Or you're probably looking at it now. So supplies expense, debit 3880, and then supplies 3880. So there's the credit, and there's the debit. D, 2/3 of the work related to $15,000 of cash received in advance was performed during this period. All right, so D, a long time ago, maybe last month, earlier in the month, they received a check for $15,000 for work they need to do. Somebody went ahead and paid in advance. So we put it in unearned. I didn't leave enough room, so we'll just put it on 2 lines. Unearned revenue for $15,000, okay? Unearned revenue is a liability. It is a liability. Now what they're saying is 2/3, we can divide it by 3, and 1/3 is 5,000, and 2/3 is 10, right? You can do it that way if you like. That's actually how I break it down in my head, but I think the fastest way to write it out is this. Goodness, there we go. You pick your poison. I like it either way. All right, so that means we've now earned $10,000. So the journal entry to record that it's been earned, we already got the cash, right? We just didn't count it as revenue. We'll debit unearned revenue to reduce the liability, because remember, liability is normal balance. To increase liabilities is a credit. And that's how we increased the liability right there, $15,000. We increased the asset, cash, by $15,000. There's no revenue. To get the revenue, we will now, once it's earned, we'll debit unearned, reduce the liability, and then we'll credit revenue by $10,000 to increase revenue. That's D. E. Prepaid rent has a $6,800 debit balance. I'm going to erase while I read if I can. On December 31st, before adjusting for the cost of expired prepaid rent. An analysis of rental agreement showed that $5,800 of prepaid rent had expired. Y'all, I don't know about y'all, but I love it. They did the math for us. There's nothing to do. I like it. So it's expired. That's expense. When I see expired, I think expense, okay? Or probably an expense, okay? All right, so and there we go. My word froze. So we'll debit rent expense for the amount that's expired. Remember, this is expired. And we'll credit prepaid rent because rent's an asset, and we're going to lower the asset down because we've consumed. It's like spending cash but delayed, if you want to look at it that way. And then we got wage expense. Basically what's going on here is we need to pay people, but it's not payday yet. So a lot of times, what happens if payday's on Friday, but that's like November 2nd. Right now it's October when I'm doing this video, so it's next month, right? And you got a few days for this month, but you're paying people next month. So you got a few days in October, a few days in November. Or in this case, a few days in December, and then we'll pay people in January. Same difference. The cutoff's December 31st. So wages through December 31st, and it's not payday yet, so we can't record payroll expense. We're going to record it as a payable and then the expense. We're not going to pay them, no cash involved. $3,200 for whatever is in December. So we're going to debit wage expense, $3,200, and wages payable, $3,200. Now, if that F doesn't make sense, we'll drive this one home with this last problem for this video. I assume you've read the problem. Please stop the video, read it, and then start back, okay? Because I'm going to assume you've read it, and I'm going to try to knock this out in a minute. We have 5 employees, each make $250 a day. They're paid on Fridays for Monday through Friday of the same week. So we need to make sure that we expense, because they're not getting paid until Friday, right? Next year, we need to make sure we expense December 31st, which is one day, 5 employees. So 5 employees paid $250 a day is $1,250. So debit wage expense, $1,250, but put it in a payable because we're not paying them today on December 31st. So this way we can record expenses for that one day that's still in December, even though they're not getting paid until January 4th. Payday's January 4th. They don't work on Tuesday. 3 days, 1, 2, 3 times $1,250 each day is $3,750 plus wages payable from here, $1,250, cash $5,000. Total of the two credits equals $5,000. This is how we're going to record payroll on January 4th. Expense for December 31st here. The rest of the week for this year here totals up to be $5,000. This concludes the video.